Now, classes of stock, common stock and preferred stock. Common stock, this is the basic form of stock. It has the four basic rights: right to receive dividend, right for election, preemptive right, the right to receive dividend as well, this one, and also liquidation. These four rights. These four rights have are the rights for common stock. Alright? Plus common stock take more risk and hence receive more profit. High risk, high profit. What are the preferred stock? So they receive the dividend first, right? Plus they receive fixed dividend. If profit increase, they would be given only fixed amount of dividend, just like interest. But one thing different from preferred stock and bonds are just that bonds have maturity value, maturity life. Preferred stock, they don't have the maturity life. All right, these are the owners, and bonds payables, they are the debtors or outsiders. So they receive assets first in liquidation. If liquidation occurs, they will be given preference to pay back, but after liabilities. So only few corporation issues this preferred stock. You can say only 9% in all over America. All right. So what are the differences between common stock, preferred stock, and long-term debt? So obligation to pay principals, no, because they don't have the maturity life. Their life is unlimited. So here, yes, they have the obligation to pay the principal in case of long-term debt or bonds. Dividend or interest and preferred stock, you are receiving dividends, but on long-term debt you are receiving interest. And companies save tax on long-term liability, but not on common stock and preferred stock. The last one is obligation to pay dividend on common stock. Yes, but when you decided to pay, when you declared the dividend, then you have obligation. Otherwise, there is no obligation for a company to pay the dividend. Why? Because all the earnings will go back to retained earning, and when retained earning rises, the value of the stock, value of the share price started to increase. All right. But when company declare the dividend, we will pay in annual general meeting. When the company say we will pay 5%, when they announce it, then they must pay. Then they are obligated to pay. All right. But in this case, bonds, you must pay on your dates, whatever the dates that are printed on the bonds, 1st January and 1st July. Then you must pay on these specified dates, right? Par value or no par value. So stocks are issued with the par value and no par value, which means if stock on the face of the stock, if some value is written, for example $10 stock, this is called par value stock. If stock issued with no value inside, that means we call this no par value. The treatment is little bit different, but par value stocks are normally issued at low price, $1, $2, $1 or $10, not $1,000 like bonds. Bonds normally are issued. One bond is normally issued at $1,000. So why we kept this price low? Because so that the shareholders can afford to buy the shares, so that all the masses they can afford this share. So you can collect large amount of capital from people, right? No par value may have a stated value. We'll talk about this when we record this no par value stock. So let's talk about this. Issuance of stock. Home Depot needs to raise 100 million through issuance of stock. So this is the amount 100 million. Suppose Home Depot common stock had carried a par value equal to the issuance of price 100 per share. So how many stocks they need to issue? 100 million divided by 10. Answer is 10 million stocks. Which kind of stocks? Common stocks. Because whenever the question is silent, automatically assume that we are talking about common stock, because preferred stock rarely issued by the company. All right. So when company issued and received 100 million, so how many shares company issued? 10 million multiplied by 10. Answer is, so cash received 100 million and common stock 100 million, and number of common stocks are 10 million. All right. Not that big deal. Cash increase, debit. Owner's equity increase, credit. Cash to owner equity, especially name of owner equity is common stock. Understand everyone?
Yes.
Okay. What if company issues above the par? What if company issue above the par? So value of one share is, okay, let's read the Home Depot needs to raise 100 million through issuance of stock. The common stock had a par value 0.05. All right, but company issues the stock as $10 per share. So what is the face value of the stock? 0.05, and they issued in the market $10. So how much is the premium? 9.95. All right, plus 0.05. Answer is 10. Right, so this is par, and this 9.95 is the premium. So what we call premium in common stock? Additional paid in capital. All right, so cash received 100 million, 100 million, and how many shares are issued? 10 million, 10 each. But what is the value of common stock? So 10 million multiplied by 0.05 shares. How much? 500,000. And on the top of 99.5 million is your premium or paid in capital, additional paid in capital. Now you understand the word paid in capital? On the top of how much you have paid on additional paid in capital. Right, guys? So this is just like a premium on bond, but we don't call it in the case of stocks. We call it paid in capital or additional paid in capital. One and the same thing. So you understand the entry here? Cash to common stock to paid in capital. When we have a par value 0.05, this is the issuance value. So how we are going to write it down on balance sheet under stockholder equity? Authorized capital 10 million, paid in capital, sorry, common stock 500,000, and they mention on the account side that authorized capital is 10 million shares. Sorry, 10 billion shares. Authorized capital is 10 billion shares, and 10 million shares are issued. So 10 million multiplied by 0.05, answer is 500,000 value in dollars. And how much is additional paid in capital? 99.5 million. Answer is 100 million. Retained earnings, we write it down on below the paid in capital and common stock. And our total shareholder equity would be 600 million. Guys, you understand? Oliver,
Yes.
Yeah,
Marco, Subhan, Faik, Sufyan, Pavarun.
Yes, I understand, sir.
Oh,
Yes.
good, 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 good. All right. Now, what is the treatment of no par value? Which means we are not given any par value. Simple, we don't write additional paid in capital account. Why? Because there is no premium, because no par value is given. So, Apple Incorporation issues 939 million shares of no par. So, how many number of shares? 939 million shares. Common stock worth of 16,422 million. So, how much they have issued? Shares 939 million, and they receive the amount 16,422 million. So, cash received 16,422 against common stock. That's it. There is no additional paid in capital. Why? Because we don't have any par value. Just we write it down, okay? 939 million shares. That's it. Number of shares are 939. Par value, no par value. Alright? How they are being issued? Simple. Common stock, no par value. Authorized capital, they can increase 1800 shares of no par value, and they have increased 939. What is the per share value? Not mentioned. Why? Because this is no par value. 1642, 16,422. Retained earning is here, and this is other cumulative income. This is part of total shareholder equity, but other comprehensive income means, for example, the Apple China remit the yuan to the head office of America in dollars. So, currency gain that you receive when converting yuan into dollars is called other comprehensive income. And that is not, company didn't take any risk, any business risk, company didn't do anything, just converted the profit into yuan, yuan profit into dollars, and receive more dollars due to currency appreciation. So this is one kind of other comprehensive income. This is not the part of our discussion, just to quench the thirst of curiosity here. What do we mean by other comprehensive income? All right. So in general term, shareholder equity consists of common stock and retained earnings. All right. And the third part is OCI, other comprehensive income, which rarely happens. All right. But when the company is multinational,